I've done tech, but what about the business? Trading is still very daunting and it's still very, very risky. Options trading is an exciting space, or trading in general is an exciting space to be in. It's very hard to find a realized unmet need. You are hedging the volatility in the market, which affects your business basically and the pricing of your products. Futures and options for retail largely make sense from a monthly wealth creation perspective, basically.
Can I buy aluminum futures myself? Is that how it works? Hello and welcome to this episode of Prime Podcast. I'm Shripati Acharya with Prime, and my guest today is co-founder and CEO of Punch, Amit Dhakad. Punch is an innovative new options brokerage that is making it safe and easy for young Indians to participate in options trading. Welcome to the show, Amit.
Thank you, Shripati, for having me here. Pleasure.
All right, so let's just dive right into it. So Punch is an options trading platform. So what got you interested in the financial markets in the first place, and when was that?
Actually, for 28 years of my life, I was running away from financial markets with no interest. I was wanted to be a surgeon, turned out to be an engineer, and completely not interested in financial markets. Like, my interest lied in science, technology, and all of those spaces. It turned out that as an accident, my father needed something for about 6 months in the commodities market, and being a tech guy, it was really an interesting challenge to look at streaming millions of messages to sort of many concurrent users. And because of the tech interest and the time that I had in hand, I just happened to enter financial market. And a year into it, I got married. And my wife, who's also my co-founder, turned out to be a financial market geek. Like, she worked at a broker, and she was a trader, and hardcore worked in the exchange for like 5 years. So I think because of my father and because of my wife is where I am in this space, and largely because I am a tech and a product person, my entire perspective in this this is my 9th year in the financial markets now. It's all been around understanding consumers and figuring out how tech and product design can actually benefit in this particular space. I stay in financial markets because it's just fascinating. The consumer segment is fascinating. The evolution in this space is fascinating. And as a business, you can actually build a very, very sustainable and profitable business in this space. So I think it's an accidental journey to get here, but I think the dots just connected if I look behind.
Well, I think financial markets are like the grease which really propels the economy in one sense. So it's very, very core and fundamental to any well-developed capital market. So you're interested in financial markets. What do you do then? You're helping your dad, you've gotten married, Peter is saying, let's do something. Then what happens?
So I think it started off with, like, while all of these were catalyst, I think you can only go down the path if you're totally excited about the problem at hand. So for me, the tech challenge was like really, really exciting. I think back in 2019, the Indian traders did not even have access to basic financial information like a stock price. And I think I was very stunned from coming from a technology background that why are we so behind in technology here? And I saw an opportunity to do something that was very fascinating. So I think the tech helped me go and build and provide access to capital markets to Indian traders. And in my initial journey, I thought that, okay, maybe, there'll be like 10-15,000 people who will be interested in a product like this. And within a span, I just could not believe myself that so many people could actually get access to it and needed access to it.
So what exactly was the product?
The product was very simple. It was just providing real-time stock market prices. It's so lame today, right? But in 2016, it just went berserk because nobody had even access to that. They would need to open their desktop, log into their broker terminal and actually see it. It was that state that we were in 2016. And no player in the industry was really willing to actually invest in a mobile platform because I mean, trading, investing has always been a very serious business, very desktop, 4 screen setups and all. But I came from a technology background, and I had taken a bet in 2008 that mobile is going to be the future. And I detached myself from web and desktop and all. So this 2016 was the turning point. And then I think as one problem after the other, we really enjoyed the tech challenge which existed. And then in 2019 is when we started sort of seeing that, okay, I've done tech, but what about the business? Because I moved from a tech to started to think like a CEO and a business. And I was like, okay, we just forgot about that basically. And I think that's when we started thinking that, okay, broking is the way forward for us basically. That is where huge revenue pools lie. The impact that will be create will be larger. We'll be able to bring a lot more India to sort of the participate in capital markets, and the Indian economy can only grow if people actually participate in the markets, right? It's very, very important to it. So I think I found a purpose. I, found a very interesting tech product problem to solve. And I love the capital markets and the trader segment particularly. So I think that's kind of...
Okay, so you went from providing real-time quotes to what product?
So it started off with real-time quotes. And after that, we started getting a pull from the traders that they needed technical charts. Then they said that they need these tools. And all of these were very interesting and exciting. So it started with information and then went on to analysis and then went on to decision making and went on to discovery basically, right? So we solved all of this piece of puzzle. Until about 2020, the product had like almost 25% of the trading population on it. Really one of the great analytical tools basically available for decision making on a mobile device, right? On a simple mobile device. I think so kind of that happened. And then once we had like almost 500,000 traders active on our platform in 2020 is when we decided that, okay, now it's time to sort of get into execution, because all of this is happening, but execution is happening somewhere else. And we did initially try to stay an analysis and discovery platform and tie up with other brokerage firms to facilitate execution. But that miserably failed. We didn't get the quality of execution that we wanted and to provide to our consumers. And we still felt that it's for the young India and the new generation of traders that are coming in, the current existing products are just not enabling a lot of people to come in. Trading is still very daunting and it's still very, very risky. Right, the perception's that, and it is invariably. Everyone's trying to solve it with education, but we are a product design company. So we sort of felt that there is a product should be able to make options trading less daunting, and a product should be able to get built-in safety into it. And if both of these can happen, options trading is an exciting space, or trading in general is an exciting space to be in. And we felt that, okay, from a business perspective, it made sense to go into broking. And from a product perspective, we felt that there's a huge potential for us to do something so that the market can go from like 4 million, 8 million traders all the way to like sort of 80, 100 million traders in this decade, right? So I think that's kind of how the journey's been.
So that was, the analytical platform was Market Pulse.
Yeah.
Right? And so how many users does Market Pulse have today?
Close to around 600,000 monthly.
All organic
users. All organic. Zero marketing spend, zero brand, zero nothing. Like it's actually very interesting. 70% of our downloads come from the keyword Market Pulse. So that's kind of how that entire business has been built.
That's stunning. So you went from doing real-time market quotes to providing one of the most widely used analytical tools. Yeah. And then to go even from there to execution, which provided the same ease of use and the same intuitive mobile interface to trade executions on options.
Yeah.
So tell us about Punch.
I think Punch started about 1.5 years back. At least the journey started 1.5 years back. Now, we decided we'll be a broker first. And we decided that product design is going to be something that we're going to solve the problem with, right? Because we knew where this industry is going and what it sort of is missing basically. And I think from there, the journey really started with understanding the consumers. Now, in this space that we are in, right, which will largely also happen with a lot of startups in this decade, it's very hard to find a realized unmet need, right? In our space, there are already many billion-dollar businesses, many brokers already existing, quite matured ones, young startups as well. So I think from that perspective, we needed to go really deep into the consumer's psychographic analysis, understanding what do they really need and not what the current segment needs, what people coming into this generation would need in this decade basically, right? And how would options trading go from like 4 million to like 80 million basically. So I think from that perspective, we were very clear that we needed to touch upon the core barriers to expansion. Now there are two key barriers. One is of capital requirement and second is of access basically. Now capital requirement is something that's the regulator's job to kind of facilitate that. But when it comes to intermediaries like ourselves, it's access basically. And we knew that access is going to be solved with good intuitive product design basically. So I think that's where it started off. Then it's a lot of consumer research, consumer understanding to be able to literally come up with a intuitive product which hopefully will take the industry in a different direction as far as trading platforms are concerned basically. So I think that sounds
so let's bubble up a little bit and provide for our listeners a little bit of context on what are options, right? People understand what stocks are, right? You buy a share, you sell a share, you buy, Reliance Industries, or you buy, Aditya Birla Group or whatever it is, right? And those we understand, right? What are options? And why is it even important?
So I think fundamentally we should look at the reason for creating options is generally hedging. That's essentially why it's sort of really created. Futures and options are derivative products. Let me simplify it and help sort of the listeners understand what is futures and what is really options. So I think of it as the fundamental is a Reliance stock, right? That is what you buy, that is what you sell basically. But at the end of the day, why are futures created? So let's take a commodity example, and that's very easy for everybody to understand. Let's say you are a manufacturing unit and you've got an order to build, let's say, iPhones, right? And you're going to need aluminum to do it. So now today you're going to crack or negotiate the deal basically, right? But the aluminum shipment is going to come, let's say, a month down the line or 2 months down the line. You don't know what the price of aluminum will be a month down the line or 2 months down the line. How can you decide the margin today? How can you decide the cost price today, right? So what you end up doing, that's why futures are created. So what you end up doing basically is you actually buy aluminum at a future price basically. And that price enables you to sort of lock in your raw material price basically, so that you're able to predictably control your margins and then do it, right? So then what happens is a month down the line when the aluminum shipment comes in basically, the future contracts that you have bought, right? You sell those and you get this shipment and kind of it settles it out basically. Right. So what this fundamentally means is you're hedging the volatility in the market which affects your business basically and the pricing of your products. That's what derivatives are built for. That's what futures is built for. That's what options is built for largely, right?
So they play a very fundamental role in business because
very fundamental.
It is removing the uncertainty associated with price movements out in the future. In your particular case, you're talking about aluminum. You're buying for 100 rupees. You want to put in a margin on top of it, a 20 rupees of margin. But if suppose the price of aluminum goes down to 150, it's a big problem. So you go ahead and buy a futures contract which locks in the price that in 3 months from now I'm going to buy aluminum at 100, and you of course pay something for it. And when that way, whatever be the price of aluminum, you're at least guaranteed no more than 100, right? So that's what it is.
I think for the listener, the mechanics are irrelevant. So it gets into complicated zone. It's very simple. I have seen that, okay, the price of aluminum is 100 for me today, it gets locked in at 100 for you. It doesn't matter if the world moves left or it moves right. For you, the price of aluminum is locked at 100. That gives predictability. You can't control the actual underlying price basically. But through futures and options, you will be able to control and lock in your price basically. That's what this essentially allows you to do.
Mm-hmm. So then let's translate it to what happens in the market specifically. Am I as a retail person, can I buy aluminum futures myself? Is that how it works?
Yes, absolutely. So to buy futures or to buy options, you don't really need to have commitment in the physical stock, right? So it's not like you need to have an aluminum container shipping to you to be able to buy a futures. It does not really work that way, right?
Yeah.
So ultimately hedging, right, is largely for companies, businesses, and also for large institutions who are sort of taking a large bet in a particular portfolio. And then sometimes you have a large portfolio, but you know that there is a certain event that's going to happen that's going to shake the market. So you take opposite positions, you take positions in different instruments, you move your money around to be able to hedge your risks largely, right? That's where all of this happens. But as far as retail participation is concerned, hedging isn't the reason why they are there in the market. That's not sort of what is really happening. Now, when retail is participating in the market, right, they are fundamentally sort of coming in with the intent not of hedging, with the intent of creating wealth, period, right? Businesses are getting in and getting into derivatives with the intent to sort of hedge. Institutions are getting in as part of their overall strategy to be able to sort of hedge or create wealth, whatever it is. But when it comes to retail, they're purely coming in from the perspective of generating wealth. Now, when it comes to retail traders, the opportunities are many. You can generate wealth using fixed deposit, you can generate wealth using mutual funds, you can do it via stocks, you can do it via futures, you can do it via options. Now, how does a retail trader really decide this? There are three primary criteria. One, capital requirement. Second is the risk I'm willing to take, and the reward that I'm looking for. So let's say you're a very risk averse person and you've got ₹1,00,000 and you're okay with a 6-7% reward on an annual basis. FD is the right way to go about it. If you're like, oh no, I want to get 15% return basically, but I don't really want to lose this capital. I'm okay to lose 5-10%. Then you'll choose mutual funds basically. Similarly, if somebody is very enthusiastic and wants to get that 20-25%, then they get into stocks basically. But with mutual fund, with stocks, the return that you get, the capital requirement is very high.
Okay.
Right? Now, in futures also the capital requirement is higher. But in options, the capital requirement reduces basically. Now, why is that? Right? Because it's a derivative contract. And particularly in India, you are actually paying for just the option premium. Now, I don't want to go too much into detail.
That's correct.
But let's say, for example, the price of a share is ₹1,000. The option premium could even be ₹5. It could be even ₹50. It could even be ₹100. Right? So now what's happening here? Let's say you actually are coming in and you're like, okay, I want to put in ₹1,00,000 into Reliance, and I think Reliance is going to go up over the next 1 year by 5%. Go for stocks. Buy the stock, keep it for yourself, and that's pretty much it. However, if you think that, okay, no, I'm coming in and I think that Reliance is going to go up in the next 30 days in a particular 5-10%, then maybe you can do cash and then you'll need ₹1,00,000, but you can take that same thesis and actually choose options, and your capital requirement will drop down to maybe ₹10,000, right?
Got it.
So the risk reward ratios keep differing. Now what ends up happening basically is in mutual funds, you'll lose maximum 5, 10, 15, 20% capital, right? And over a long period of time. But in options, you can put in 10,000 and all of that can go to zero by the time the contract expires, which could just be a week or a month at max, basically. So I think it's all about the capital requirement, the risk that you're willing to take, the reward that you need in return, basically. And how are you thinking about wealth creation? Are you thinking about wealth creation from a 10-year perspective? Are you thinking about wealth creation from a year perspective? Or are you thinking about it from a month perspective? Futures and options for retail largely make sense from a monthly wealth creation perspective, basically, as opposed to long term.
Fair enough. And of course, as you mentioned that with the opportunity for high gains comes the commensurate downside that you might actually do the very large portion up to 100% of your invested capital. Understood. So what is the opportunity you saw when you looked at this scenario and said, well, we actually have the opportunity to start a company in this space? Right? What was it in your mind which was actually the unmet need here? Or maybe even a latent unmet need, which is the consumer hasn't articulated, but it's out there.
Fair. So I think access was there, right? And capital requirement was also dropping. So a lot more people were able to come in and participate in trading, right? Which we have seen over the last 4 years. There's been a whole propulsion of people coming in actually trading, right? Largely facilitated by both of these factors. However, options trading is daunting and options trading is risky still exists, which means that it's as compared to mutual funds and stocks, this is a high speed activity basically, where you're going to make money fast and you're going to lose money fast. And invariably, we all know that 99% people actually don't end up making sufficient capital basically, right? So I think we just knew that there is this big problem basically, right? So from a broker's perspective, like what is our job? We are intermediaries, right? And for us, it is about access. So now while access is provided, what is there to solve more now, right? But this problem still exists. There is enough education out there, not really helping, right? We were in the analysis space, informed decision-making space. Can we help people make better decisions, better informed decisions? We've tried that as well, didn't change much. So many players have tried, but the statistics don't change, right? So in that sense, we knew that there is still a very big problem of why options trading is so daunting for somebody to get into, and why is it so risky basically. So we try to understand these two problems, and today we are at that point where we are like, okay, we are going to work for the next few years to actually be able to make options trading less complicated basically, and through product design, not through education, and be able to ensure that people can actually do this fast-paced trading with safety on basically, right? So you get substantial time to stay in the market. You can actually learn about the market because you'll have to be in the market to learn. There's no other way basically. But if you could actually limit the losses that you make, you can increase the longevity of how you can stay in the market basically. Then in 6 months, a year and a half, you can get to a place where you actually start understanding the pulse of what this is, how to go about it, what is working for you basically, right? And I think that is the big opportunity that we see. So from all our consumer insights and research and everything that we've done, we've understood that people who stay in options trading have gone through a lot of heartburn and a lot of burns generally to get to a point where they can stay in the market. So there is a clear problem, which means that the journey of the trader in that 0 to 6 months, 0 to 1 year is very hard. They don't really have a clear path. They don't know how to go about it. They burn their hands. They are getting their emotions in the way. And while a lot of education exists, platforms aren't helping them do that. So I think we clearly see that there is a big problem there. And if we can solve and address that, I think we can significantly sort of increase the participation of people in the market, where a lot more people should be able to come into this to participate, try their hand with it, and actually do it safely, as opposed to just like, burning their hands basically. So I think there is a very big role of product design to be played here.
So by safely, do you mean, Amit, here that they have a certain point of view about the kind of and the level of risk which they are comfortable taking, and they shouldn't inadvertently end up taking a higher risk than what they intended. Is that how you're thinking about safety, or is there more to it?
So I think we should look at safety very simply in this manner where if I look at an analogy, right, like it's like you may want to drive at 100 kilometers an hour or 150 kilometers an hour or 20 kilometers an hour, but you need to have a seatbelt on and you need airbags and you need your ABS systems, right? You need all of these safety things. Otherwise, you're going to end up with a crash. I think what people end up doing is they sit in the car, they don't do any of this, and they just put their foot on the pedal and they run really fast and they end up crashing basically, right? And largely it happens because of emotions, which we all sort of understand. But it also happens because of complete lack of like what to do basically. And in that impulse of what they see in the market, overconfidence, a lot of these emotions. And so I think there is a role for a product to play. See, education a lot of people have done, and every trader you speak to, they also know that they should be doing this, but it does not work, right? So I think there is a role for somebody to come in and be able to say that, okay, you drive, but the seatbelt, the ABS, the airbags, all of these things are just automated. They're just there, like we'll take care of it basically so that you're safe largely, right? So I think, and then there are certain guard rules also, right? Like, so I think fundamentally, people learn about safety only after burning their hands multiple times. When they go in the search to see how to do it safely, how to not burn their hands, because they come in with overconfidence and with aggression, and it's like, okay, I'm just going to do it. My friend could do it, so I'll do it. And then you burn your hands a couple of times, and then you realize that, okay, now I should sort of do it this way. So I think we could fundamentally sort of built-in safety and ease, and if you do the two together, I think people would not like take 6-9 months to figure out how to do things, right? They would just be able to sit in the car for the first time, put in the seatbelt, have the ABS, have the airbags, and then drive safely. So
very good. So what next for Punch? So the product is out in the market, right now. Yeah. You can download the product and then do all the KYC and all that good stuff, and then you can use it. So what next for Punch? I mean, how are you thinking? Not just maybe from an even Punch standpoint, I think I should say your views on the markets. Like where do you think this is going?
So I think from a capital market perspective, we are just getting started. I think, right? Like if you look at US, if you look at China, if you look at Brazil, the participation in capital markets is huge, right? And as I mentioned earlier, right, like there are three aspects basically, actually two fundamentally. There is capital requirement, and second is avenues to invest or trade in.
Now, by capital requirement, just to clarify, you mean the amount of capital that the user has to bring in.
User has to bring in.
Deploy.
Right? Okay. So if you look at in the US, the capital requirement to participate is lower.
I see.
Right? Like fractional shares, for example. Right? And capital available is higher. Right? And then the avenues to invest in are many. Many different products, variety of products exist. Complex products exist out there for you to invest or trade in, for that matter, right? Like there are water futures in the US, right? Like it's crazy, right?
Which means exactly what is a water future? The cost of water? Or?
Yeah. You're betting on water and water scarcity in the future and stuff like that, right? Yeah. Like there are very complex products like that. India doesn't have that. So in India, the capital requirement is very high. The capital available, disposable income with people is lower as an entire population, India population. And then the avenues to invest in are very limited. There's mutual funds, there's stocks, and there's options. And that's it. In fact, in options, we have almost 8 times more turnover than US. It's amazing, right? NSE exchange as an exchange is the highest volume of option turnover contracts happening across the world, right? But there are only 2 which constitute almost 70 to 80% of the volume. Two indices, that's it, right? So it's huge number of this thing, but the concentration is very, very small. So the diversity in products is missing, right? And we're getting started now. So now I think over this decade, what we will see is bond markets will come in, alternative investments come in, secondary investing in secondary shares in private companies could come in, investing in US markets could come in, right?
And maybe even options for regular equities, right?
Absolutely. They do exist, but then there are guardrails, right? Even like, for example, Indian market is controlled by like 50 to 100 companies, right? Like top 15 companies could move the
when you say
stock
control,
market.
Meaning like the index participation is very high.
Very high. Yeah. And like if a Reliance goes down 10%, the whole stock market can move a bit, right?
Index,
so it's from that perspective. So I think as the number of companies increase, as the number of avenues for people to invest in and trade in increase, as the capital of disposable income for people start increasing, and as the capital requirements are, which is happening invariably, these are all tailwinds in this, right? So I think over this decade, we will see this 10% participation go all the way to 40-50% participation. It will invariably happen because all of these four variables are changing very rapidly, evolving very, very fast. And the interest to be in capital market exists. Now, the bigger thing is, apart from capital market, the traditional ways of generating wealth, which is real estate and gold, are very high in capital requirement, which the young generation won't have. So these are going to be the avenues to sort of, so stock market is, I think we're just getting started. We have seen a very big influx in the last 4 years, but unfortunately the influx has happened like, I think the maturity will come in the economy when people start coming in for the right reasons. I think a lot of people, and especially the millennials, the Gen X, and the last 2 decades, a lot of people that came in also, right, come in with a very frivolous mindset in the sense of I'll put in something and I'll get something in return. I think that narrative changing, and which is changing with the Gen Z especially, basically. I think they are less risk averse. They are more pragmatic about what they are expecting out of the market. They're not looking for Lamborghinis. They're not looking for like retiring out of the stock market. They understand it's a side hustle. They're not willing to give up their jobs to actually get into like investing or trading. Right? They understand that they don't want to put everything into one thing. They want to make sure that they're diversifying. So they're putting it into stock, mutual funds. They'll put it into stocks. They'll put it into trading. They'll do crypto as well. They do gold as well. They want to diversify basically, right? And in general, they are learning about the market, getting educated and making very informed decisions. And they don't want quick bucks and return. They're patient about learning this as a skill basically, which I think will fundamentally shape the Indian capital market. So the regulators doing a great, fantastic job with building safety and yet bringing openness into the market. The regulators are moving from very distribution, sales-oriented organizations to product organizations, basically. And the consumers getting more pragmatic and more aware and more informed, basically. As the sort of foundation of the market changes with capital requirement and with avenues to invest in with a variety of products, I think we are just ripe for the next 10 years for capital market participation in India to just blow out of proportion.
So what you're saying, Amit, here is that we are going to see more instruments available. I mean, the options itself will probably have a lot more derivatives available there in terms of
not just derivatives, just the avenues to invest in. Like avenues to invest in debt market, the avenue to invest in private companies, the avenues to invest in more stocks for that matter, more IPOs happening basically. Like today when an IPO happens, you actually just cross your fingers and pray you will get one share,
right,
and you don't end up getting it. Right? Yes. That's the problem, right? Yeah. So I think that is access, right? That is an avenue problem.
Demand supply mismatch, because the demand for getting these equities and IPO markets is much higher than what the supply is. Yeah.
And if somebody has like just 3,000 rupees disposable income in a month, it's just very hard. It makes no sense. Like, I mean, you put in 3,000 rupees in a mutual fund and you're like, okay, 10 saal baad kuch hoga basically. So I think the avenues will open up and more opportunities will happen. Like a classic example is the corporate bond market, right? The minimum face value was about 1 lakh rupees, right? SEBI recently changed that to 10,000. So now that's 1/10 the requirement, which means now with 10,000 rupees, I can sort of get into this particular space, right? Otherwise I could not. So I think these are very important changes. So more variety of options to sort of invest in and trade in, and at the same time lower capital requirement. Just fundamentally change the game.
So you're saying that from a regulator side, a lot of tailwinds to basically increase the level of participation in the capital markets, and of course, then a lot more instruments getting into the capital markets and avenues for people to invest in. It just creates a lot of opportunities for startups like yourselves to come in and help be the preferred option for the user. So that's really helpful. So let me just ask you one, perhaps a closing question here, which is that now you have been doing this, you said, since 2016, maybe, so like 8 years there. So what is it that you know now that you wish you knew then before you started? If you were to tell, Amit Dhakad of 2016, a few things as he embarked on this journey in financial markets and startups and product, what would you say?
So, fundamentally, I think if I had to look back, I would actually, in 2016, I would tell myself that I should have thought about business, right? I think I thought about tech and I got super excited with it and I focused very, very strong because I was a tech guy, right? At the end of the day. And I really cracked very hard tech problems. But I think if I had started my broking journey in 2016, I would have built a very large business, and at the same time I would have created a greater impact than what I did actually, right? So I think fundamentally for every entrepreneur, I think what's important, specifically when you're coming into fintech, I think one will need to figure out monetization very, very soon. I think leaving monetization to a very later point in time is not going to be a good idea because the market's going to take time to sort of expand. It's still shallow markets. It'll expand over the next 10 years. But I think the monetization possibilities to build a very large business are very few, right? You can either be an exchange, you can either be a broker, you can either be a mutual fund house, or you could be a lender. There isn't anything beyond these four. So I think if in 2016, I didn't think just about solving a tech problem, but I thought that, okay, how am I going to create a very large business, right? How am I going to create a very large outcome for the industry, for shareholders, for myself? I would have taken a completely different direction. I would have thought very differently, basically. And I would have picked up the same product and the design and the tech problem because that's who I am at the heart. But I would have not chosen the analysis and information part. I would have done that, but I would have started execution back then in 2016. So I think for all budding entrepreneurs, I think the thing really is to be able to, sort of go beyond what their just passion for problem solving is, and starting to ask themselves that question that, okay, where do you want to be like 5 years from now? And I didn't ask myself that question in 2016. I was just excited to take one step, then the second step, and then the third step. Only to ask myself that question in 2019. Right? So I would have asked myself that question in 2016.
Well, I think that's a very honest answer, Amit. But well, you asked it ultimately, and Punch was the answer. Yeah. So all the best. Good luck with the journey for Punch. Yeah. And thank you for being with us today at Prime Podcast.
Listeners, thank you for listening to this episode of the podcast. Subscribe now on your favorite podcast app for free, and you'll be the first one to know when new episodes are available. Just search for Prime Venture Partners Podcast in Apple Podcast, Spotify, Castbox, or however you get your podcasts. Then hit subscribe. And if you have enjoyed the show, we would be really grateful if you leave us a review on Apple Podcast. To read the full transcript, find the link in the show notes.